Hey guys, so I just got done watching the video that you're about to watch, and I wanted to add a couple of quick sort of disclaimers at the beginning of it that I neglected to include. The first is that nothing that I'm saying should be construed as financial advice. You have to make those decisions on your own. I used to have licenses that are, associated with being an investment advisor. I've never acted as an investment advisor for anyone, but I used to work for a broker-dealer where people in my position were required to have those licenses. They're no longer active. I'm no longer licensed because I'm no longer employed by a broker-dealer. But what they drill into you in getting your Series 7 test and others is that you cannot give investment advice without understanding the investment objectives and needs of the individual to whom you're giving that advice. And that really is the biggest thing that I could probably communicate. There's no single right answer about what to do with money. It always depends both on what's going on in the overall economy, but especially on your specific situation. What are your needs? What are your objectives? What's your risk tolerance? And those are very personal things. So, when you work with a financial advisor at an RIA or at a big bank, they have to determine the suitability of different investments by having you fill out a big form explaining what's your income, what's your net worth, what's your debt, what are your investment objectives. So I'm not going through that process with any of you, so none of this can really be construed as proper investment advice for you. But I'm just going to try to talk about some general concepts that hopefully will be helpful. And what I'm really excited about more than anything is getting into the dialogue and the conversation with everybody out there about maybe ideas you have that are different than mine that I'd love to hear, and also about questions that you have. Maybe you want to know whether something I'm saying applies to your situation, and so you want to hear a little more about it. Or maybe you don't understand what I'm saying when I talk about inflation or deflation, or ordering of interest rates and credit and money and all that. And those are all topics I really want to get into in more depth in the future. But for this video, I just wanted to get a few thoughts out there. If you ask me about finance, what sorts of things am I likely to say? And then we can see what happens from there. So that's my caveat. I thought today I would do a video discussing some tips and thoughts on household finance and budgeting. That's been one of the more requested topics that I've received in the comments. And thank you everybody for all of those requests. Lots of great ideas. And I hope to get to a lot of them. But this seemed like something pretty practical that a lot of people were interested in. So I want to share some thoughts that I have on household finance and budgeting. Although I have to confess, this is not exactly my area of expertise. I'm in general much more interested in the theoretical aspects of things rather than the very practical ones. I'm not really a details guy, so I don't really have a monthly budget that I'm tracking in great detail. I've also been just very lucky to have a good job where I didn't have to worry too much about this stuff, but I do think that my background in finance and in trading and my personal research that I've done about economics in general, I think that does put me in a pretty good position to sort of, give perspective on the approaches that people take in general to household budgeting and kind of why some things are more important than others. And actually someone mentioned in one of the comments that Dave Ramsey is a guy who gives this kind of advice on the internet, and he has 7 baby steps for taking control of your financial situation and getting your budget in order. And I read those and they're pretty good. So I thought what I would do in this video is actually give my review of Dave Ramsey's 7 baby steps. So I know his first baby step is create a $1,000 emergency fund. This is a great idea, I think, because it's always good to have some cash on hand. You never know when an emergency is going to arise, and $1,000 is a nice round number. And if you don't already have $1,000 in a savings account or tucked under your mattress or wherever you want to put it, if you don't have that much savings, then that's probably a really good first thing to focus on, is how can you spend a little less of your paycheck each month and start to build up that savings and to set $1,000 in your savings as kind of your first achievable goal. Now, when it comes to specifically how do you spend less money each month, that I'm not going to try to offer those tips right now. Like I said, I don't think that's really where I'm an expert, although more recently in my life I've been trying to focus on that stuff more, and maybe we can come up with a lot of great ideas together. But for now, I'll just say that first baby step of get $1,000 in savings, I think is a great one from Dave Ramsey. And I know his second baby step is to start paying off your debt. And I have a few more comments on that. Let me read what he said exactly again and refresh my memory. So Dave Ramsey for step 2 says to start paying off all of your debt, excluding your mortgage if you have a mortgage, which I agree with, although I don't agree with how he suggests that you order the debt in terms of which you would pay off first. He says to start with the smallest balance, to put your debt in order of what the balances are and to pay off the smallest balance first. And his logic is that you'll feel really good about eliminating a debt, and psychologically that'll reinforce the behaviors that you've incorporated to try to save money and get to the point where you could pay it off, and that'll make it more likely that you pay off your other debts in the future. And while I understand that, and certainly like in my own weight loss journey, I've noticed that when I'm seeing results, I'm much more motivated to keep going, and if I'm not seeing results, it's a lot harder to keep up the motivation. But for me, the result is not about the number of debts that I have, it's about the number of dollars that I owe. If you owe $5,000 on your credit card at 15%, even if you only have $2,000 left on your student loan at a 5 or a 10% interest rate, if you have a couple $1,000s to pay off your debt with, don't pay down the student loan, pay down the credit card. That's the highest interest. That debt is costing you the most to have outstanding. So that would be my one tweak on what Dave Ramsey suggests. I would order your debts from the highest interest rate to the lowest interest rate and pay them off in that order, and feel motivated from the fact that you're getting rid of high interest rate debt. Even if your highest interest rate debt is also your biggest debt and it takes you a while to work through it, you're getting the most bang for your buck by paying off that debt. So I think it makes a lot of sense to do that first. Now, Dave Ramsey's tip number 3 is to try to accumulate 3 to 6 months of living expenses in savings, in cash savings, in a savings account. It's what most people would do. Now, so he says start with $1,000 in savings and then go to start paying off your debt and then go to try to accumulate 3 to 6 months of living expenses and savings only after you've paid off all your debt other than your mortgage. I think that this is a very, very good approach. The number one problem that people struggle with today is being in too much debt. And once you get in debt, it's hard to get out of it because of the way the interest compounds. And especially in today's investment environment where it's very hard to earn a significant return on your savings without taking an obscene amount of risk, there's just no reason to have debt and savings. Once you've got your $1,000 emergency fund, work on paying off all of the debt that you can, and only once you're debt free should you start trying to build up more of your savings, and focusing on 3 to 6 months of living expenses sounds like a very prudent thing to do. So Dave Ramsey's baby step number 4 is to try to get 15% of your income invested in tax-advantaged investment accounts, which means either a Roth IRA, which is a post-tax account, or a regular IRA or a 401k, which would be pre-tax accounts. The advantage of all of those kinds of accounts is that you pay less taxes on the gains you make on your investments. There's a little bit of math involved about which one is the best. If you're doing any of these things, you're doing fantastic. If you assume any kind of reasonable rate of growth, the Roth IRA is usually the best tax-advantaged account to choose. With the Roth IRA, you contribute post-tax dollars, which means, say you earn some income this year, you pay taxes on that income, you have some left over. If you contribute it to your Roth IRA, you will never pay capital gains taxes on any increase in the value of those investments. The capital gains tax is 20% right now, so that's a pretty big savings. A 401k or a traditional IRA is what they call a pre-tax investment vehicle, which means you don't pay income taxes this year on the funds that you invest into those accounts, so you get to contribute more than you would otherwise. However, you do have to pay the capital gains tax, but only when you withdraw money from the account, not along the way. So depending on what rate of growth you assume, one or the other can be optimal, but for any kind of reasonable rate of return on your investments, you're usually going to do better with the Roth IRA. But really, if you're doing any of those tax advantage investment savings vehicles, you're putting yourself in a very good position. So Dave Ramsey's baby step number 5 is to start saving for college. Now, he's adamant that you fund your retirement tax advantage investment accounts with 15% of your income before you start saving for college. The logic that you're going to need that money in retirement, and your kids won't be paying your bills quite yet. That's that's up to everybody's kind of personal values. How important is college to you? How important is a very expensive college? How likely is your child to get a scholarship? There's a lot of kind of very personal things there. But basically, there's 529 and one other kind of tax advantage college savings account that you can create, and that's the next thing that you want to look at doing. It's a personal decision how much you want to put into retirement investment accounts versus college saving accounts, but once you get your 3 to 6 months of living expenses, you basically want to max out your contributions as much as you can to all of those kinds of accounts. So saving for college for your kids is Dave Ramsey's baby step number 5, and then his baby step number 6 is to pay off your mortgage early. It's certainly, it can be a very prudent thing to do, but it's not always the right thing for everyone. It depends on a lot of variables. The thing about a big mortgage, there's 3 things about a mortgage that make it more attractive debt than other kinds of debt. The first is that the mortgage interest is deductible from your income up to a certain amount. So that lowers the effective rate of interest on the mortgage. The second is that your mortgage interest rate tends to be the lowest kind of debt anyway, the lowest interest rate kind of debt anyway, because the collateral of the house makes it a relatively safe loan, relatively speaking. And then the third thing is that a mortgage often allows you to lock in a low interest rate for a long period of time. We're in a historically very, very low interest rate environment right now, which can very likely lead to inflation in the future. And what inflation does is it diminishes the purchasing power of each dollar, of each unit of currency, which means that the real value, the real burden to you of your mortgage amount will decrease in the future if there's inflation, and there's likely to be inflation. So if you're able to lock in a low interest rate today, when interest rates increase because of inflation in the future, it'll actually diminish the real burden of your mortgage. It's effectively a way to be short the dollar, which again is that's not a universal good. It's my personal opinion that being short the dollar is not a terrible idea. My more personal opinion is that actually for the next 6 to 18 months, the dollar may be super strong, but I think on a 10-year time horizon, being short the dollar is a really, really good idea. So I think for a lot of people, if you're locked into a long-term, low interest rate mortgage that you're very comfortable, you can make the monthly payments for, it can be extremely prudent to just continue to pay that mortgage and take any other excess savings you have, even after you've maxed out all of your tax advantage accounts and educational accounts, and try to do something else with that money. And that brings us to Dave Ramsey step number 7, which is, get into more serious investing and also give back to your family and your community and get into charitable work. Once you're to this point, you've got your emergency fund, you've paid off all your high interest rate debt, you've got your 6 months of living expenses, you're maxing out your tax advantage accounts, you've got your education savings plan, you have decided to pay off your mortgage or not pay off your mortgage, depending on what makes sense for you. If you've got some money left after that, you're doing better than most people. And certainly if you can find room for some charitable giving, that's the time to do it. And this is also when you can then start to think about well, what kind of investment portfolio do I want to create? And so that's the level where I love thinking about that problem. What kind of investment portfolio do we want to create? We're living in really unprecedented times now, if you ask me. I mentioned earlier the low interest rate environment. I believe that that's an unnatural effect of the Federal Reserve's intervention in the economy. To explain what I mean by that will require another video. But in my opinion, the effect of that situation is that it's extremely hard to earn a return on your money in this economy without taking a lot of risk. And so actually preserving the purchasing power of your wealth can be a more important investment objective than gaining a return. Now, even in that example where I said don't pay off your mortgage, continue to pay 3 or 4% interest, and that's 3 or 4% nominal interest, not real interest. Meaning, if the rate of inflation goes to 10%, you're still only paying 4% interest, and you're actually you're gaining because the value of money is decreasing by more than the amount that you have to pay is increasing. So if with your savings all you do is preserve its purchasing power and inflation is 10%, you actually need a nominal increase of 10% a year. Your purchasing power is the same, but you're just keeping up with inflation. There is an investment strategy that I'm a fan of that is focused on exactly this, that's focused on how do you preserve purchasing power, regardless of whether the economy is in a macroeconomic state of inflation or deflation, and that's called the permanent portfolio. The permanent portfolio is an investment strategy developed by this guy called Henry Brown, I think it's Harry Brown. And the idea is to just divide up your investments equally across 4 asset classes: 25% stocks, 25% bonds, 25% cash, and 25% gold or other precious metals. And his philosophy is that no matter whether the economy is growing or shrinking, whether it's inflation or deflation, at least 1 or 2 of these 4 asset classes will be outperforming. And so his portfolio balancing approach is just a simple rule where you start off with 25% in each asset class, and as prices change, your portfolio will shift to be more weighted towards whichever asset class is outperforming. Let's say stocks are doing really well, so your 25% in stocks has increased in value. Whenever it becomes more than 35% of your total portfolio, what you do is you sell stocks down back to 25% and then reinvest those proceeds across the other 3 asset classes to try to get them back to 25% as well. And on the other side, if an asset class is doing poorly and drops below 15%, you sell your highest performing asset class and buy that other one while it's low. The idea is that over time, things will revert to the mean, and if you invest according to that rule, you'll tend to be buying low and selling high, and you'll always have some exposure to whichever asset class is doing the best. I think this is an extremely prudent investment strategy. There's a fund called PRPFX that I am an investor in. My personal view about where we are in the cycles right now is that I'm way overweight precious metals and cash and way underweight bonds and stocks, both. I guess it's a little more complicated to talk about all of that. I feel like this is probably enough for one video, so I'll do some editing and see how it turns out. But I just kind of wanted to open the conversation about finance on my channel here, so I thought going over Dave Ramsey's tips would be a good way to do that. Please post any comments or questions that you have. I love to hear your feedback. It's the most fun part of this for me, and I'll be excited to try to answer some of those questions and see what else we can cover in future videos. So thanks for watching, everybody.